In this video, we are going to share with you 7 investments the rich never make. If you or someone you know is looking to start investing your hard-earned money in different areas but are not sure where to start, then you've come to the right place because by the end of this video, you are going to understand what not to invest in based on what types of investments successful and wealthy people avoid. Welcome back, Money Masters. It's another Wealthy Wednesday, where we open the kimono and reveal the secrets that the wealthy elite have been using for decades to generate massive amounts of passive income through entrepreneurship and investing. As we mentioned earlier, today we are going to be talking about 7 investments the rich never make, which will help you understand what not to invest in based on what types of investments successful and wealthy people avoid. But before we dive in, I just want to let you know that on Friday, we will be discussing 4 simple secrets of self-made millionaires. So, if you don't want to risk missing out on that episode, make sure to subscribe to our channel and hit the bell icon so that you can be notified of our next amazing video. Okay, with all that said, if you are like us and are totally committed to obtaining financial independence, then go ahead and tap that like button and let's get into it. Investment number 1. Certificates of deposit. Coming up on investment number 1, we have certificates of deposit. For those who aren't that informed about certificates of deposit, investor.gov defines it as a type of savings account that accrues interest for a fixed period on a fixed amount of money that can't be accessed once you've invested it until the period, which ranges from 6 months to as long as 5 years has passed. Sounds like a good and safe investment, right? While it does sound like a pretty straightforward deal, there are a few catches that make this deal a little hard to swallow. For one, certificates of deposit don't offer any substantial returns on investment. A lookup of recent CD rates shows that many banks only offer an annual percentage yield of less than 0.1% for a year with that money, and some banks offer an increase of up to 3.25%, but only after a maximum of 5 years have passed. That's a lot of time to not have access to your money. These investments may seem like a good deal for you, and for many, it is. But rich people find that the returns from these simply aren't high enough to justify investing in CDs, especially since you can't pull your funds out until months or even years later. Investment number 2. Bonds. Bonds are a type of debt security. According to investor.gov, what happens when you buy a bond is that you're technically lending to the issuer, who could be a government, municipality, or corporation. The issuer then pays you a specified rate of interest during the life of the bond and will repay the principal, the amount initially lent, when it matures or comes due after a set period. This does come off as a safe and reliable source of income, and this is why some millionaires do invest in bonds. That being said, wealthy people do still avoid this type of investment because of the lower returns provided at the end, which to them could have been much higher if they had instead invested in a stock market. Moreover, inflation is also a big threat to the value a bond provides. According to Investopedia, inflation erodes the purchasing power of a bond's future cash flows, given that bonds are fixed-rate investments. For example, if inflation is increasing, the return on a bond is reduced in real terms. A 3.25% return on investment may be reduced to a 0.25% return if rising inflation is 3%. All in all, the benefits and disadvantages that bonds have shown that they fit the description of a wealth preservation tool instead of a wealth generation tool, which, again, is either a deal breaker or a reason for rich people who want to make their money grow even more to not put large sums of money into bonds. What do you think about investing in bonds and certificates of deposit? Do you still think they're worthy investments in different cases? Leave us a comment down below. We'd love to discuss it. Investment number 3. Gold and other precious metals. We get that people find precious metals and gold to be very important thanks to their having an inverse relationship with the stock market. In theory, These metals can even be something of a safety net against any economic crashes or downturns since their prices increase instead of decreasing like stocks, bonds, and all prices do during those times. This ability to help offset losses in those bad situations seems enticing, but in reality, the prices of these precious metals often don't get high enough to fully compensate for the losses incurred from economic downturns, meaning that they're kind of lacking as a hedging tool, not very liquid. Investment number 4. Penny stocks. For those who aren't familiar, penny stocks are defined by Investopedia as stocks of small companies that tend to trade for less than $5 per share. It's also worth noting that these stocks aren't listed on many large exchanges, and because of that, the companies associated with these stocks aren't required to provide annual financial reports, meaning that there isn't much data that can easily be found, and the data that can be found can't be easily validated, making it harder to get a better picture of how well a particular stock will be valued. This all means that more research is needed to have a decent chance of making money from penny stocks, and what's worse is that there's no guarantee that there will be buyers for these stocks at all. Since having only a little information about a stock that can't be validated either will inevitably turn off a lot of investors. Investment number 5. Companies you have very little information about. Related to number 4 is this type of investment. Right now, you're probably thinking that stocks are the best type of investment that nearly all successful and rich people try to put money into, and you're not wrong. But it's important to remember that not all stocks make for a good investment. There are a lot of companies trading on the stock market, and a big portion of these are pretty complex and difficult for your average Joe to understand and inform their decisions based on their understanding. Some companies prove difficult for the majority of investors to understand and base their decisions on it. An article on US News Money talks about Warren Buffett's mindset when it comes to investing, which, in his own words, is to never invest in a business you cannot understand. Buffett himself sets an example of this in his not investing in Google and Amazon back in 2004 because he simply didn't understand the technology industry. While he did miss out on big winnings by not investing in them, this kind of mindset helps prevent exposure to major losses. And I think this is a good mindset to uphold. When it comes to investing, knowledge is key. And when you don't know enough, it's better to be safe and then to be sorry in most situations. Investment number 6. Collectibles. Many people feel like collectibles, such as classic cars, comic books, art, and antiques are good long-term investments as shown by their respective industries being successful and popular among many. A report by Market Decipher writes down that the collectibles market has only ever bloomed in recent years, with its market size estimated at $412 billion in 2021 and expected to reach $700 billion by 2032. However, there are a few good reasons why some wealthy people avoid investing in collectibles. The first reason they don't invest in collectibles is that collectibles don't have a real defined price and are only ever worth what the customer is willing to pay for them. This means that if you want to maximize your earnings on collectibles, you have to find the right customer willing to shell out as much or more than the price you're setting for that asset, which can be pretty difficult on its own. Another issue related to this is that public information isn't as readily available for collectibles as they are for stocks and bonds. So, it might be very difficult to gauge whether a particular collectible is genuine or a counterfeit, or if the seller is trustworthy at all. The second reason the rich don't invest in collectibles is that these collectibles don't generate income for you regularly. Collectibles are bought and possibly held for a long time until you find another buyer who's willing to pay for and buy the collectible you're holding. And yes, if things go well, the profits can be massive. But it'll take years for the investment to make a return, and in the meanwhile, it won't pay for itself like bonds, certificates of deposit, or even simple interest in bank accounts do. Add to that the costs of maintaining the quality of the collectibles. These have to be stored in right conditions for the collectibles to fetch as high a price as possible, and that takes money to accomplish, meaning that for many, Collectibles might be an outright liability for a while before it turns back into an asset. Investment number 7. Digital currencies and cryptocurrencies. We know you've probably heard a lot about digital currencies with all the talk of cryptocurrencies like Bitcoin, Ethereum, Litecoin, and a slew of other cryptocurrencies being minted. But you should trust us when we say that investing in digital currencies is probably going to leave you with less money than you initially had, which is why many rich people eschew digital currencies altogether. It wouldn't be accurate to say that absolutely no one got rich off of digital currencies though. Changpeng Zhao, Sam Bankman-Fried, and Brian Armstrong all became billionaires by helming cryptocurrency exchanges. But again, these guys are the exception and not the rule. Most people who invest in cryptocurrencies won't get as far as they did for the following reasons. The first is that digital and cryptocurrencies are not regulated by any governing bodies like the US Federal Reserve or any central banks. This means that digital currencies don't have anyone keeping watch over how they're traded or how digital currencies are minted or created, which can be a problem when trying to invest because the information you need to make an informed choice isn't as available from the get-go. This also means exit scams, where creators of cryptocurrency profit from early investors by literally pulling out all their funds from the market, may be more common as shown by the increase of exit scams and other digital currency related fraud since 2017. And lastly, we have the problem of lacking security in various digital currency exchanges. An article published on NBC News last year talked about the hacking of cryptocurrency trading platform Bitmart, which ended with over $200 million worth of cryptocurrency being stolen when a company account was hacked. The nature of digital currencies is also a disadvantage, as Esteban Castaño, the CEO and co-founder of TRM Labs, illustrates in the same article, saying that when a Fortune 500 company is hacked, credentials are stolen, and the damage can be repaired more easily than when a cryptocurrency exchange is hacked, because millions of dollars in cryptocurrency are stolen whenever it happens. And that is all 7 investments the rich never make that we have for you in this video. We hope you learned some very helpful insights from what we've shared with you today. Please don't forget to leave a like on our video if it was able to help inform and positively influence your financial decisions and lifestyle, and leave a comment down below about how you feel like this video will help you boost your overall income. Also, if you love our content, subscribe for more Money Masters content and updates so that you don't miss out on our next episode of Finance Friday, where we will be discussing 4 simple secrets of self-made millionaires. Lastly, we'd like you to consider sharing this video with at least one friend. It would mean the world to us if you would join us in our mission of helping good people like you keep more of what they earn and earn more from what you keep. That'll be all from us in this video, Money Masters. We'll see you in the next video.